My name is Jesse Vergali. You're listening to Working Capital, the real estate podcast. My guest today is Ian Formigli, Chief Investment Officer at Crowdstreet. Crowdstreet is one of the largest online private equity real estate investing platforms. Ian, how you doing today?
I'm doing good, Jesse. It's great to be back on the podcast.
Yeah, it's fantastic to have you back on. I think, you're one of the perfect guys to talk to right now in this current economic and real estate environment that we're in right now. So for those that want to check the original episode, you can go back to that. And I think it's probably been close to 2 years now, maybe a little bit shorter than that, but seems like time has been going by fairly quickly here, given the last couple of years. But for those that don't kind of know CrowdStreet or your background, Ian, maybe you could just give a little bit of a backgrounder on what you do at CrowdStreet.
Sure. Yeah. Thanks. From a high level, first, just high level on CrowdStreet is, we're an online equity syndication platform, accredited investors, typically in the US. I think we do actually have some Canadians, Jesse, that invest on the platform, if I recall correctly. But we're bringing deals to a marketplace that are generally located in the United States. We have syndicated about $4.2 billion in total aggregate equity since our inception, which dates back to April of 2014. That's been across a lot of deals. I think upwards of 800 deals at this point. I joined CrowdStreet in the summer of 2014 after the platform had gotten live, but essentially got its second deal on the platform. So I guess I've served as the key decision maker on 2 through N of deals since then. So it's been a lot of work over those years. It's been interesting to see a lot of deals come and go. Our platform is historically about 50% multifamily, 50% everything else being essentially, we look at deals in the hospitality space, industrial, retail, pretty much all the major food groups, even self-storage. We don't really do land deals. That would be probably the one area of real estate that we don't tread into. And we've done deals both from an acquisition standpoint and a development standpoint. And our general MO is to partner with operators and developers across the United States who are looking to gain access to syndication at a greater scale, bring that into their form of their capitalization of deals, possibly alongside family offices, other institutions, other high nets. And that's what we've been doing. So, that my process as CIO is to oversee our investments team. I write our investment thesis and, work on curating the types of deals that we think are ultimately going to bring to the marketplace, essentially like why this deal right now.
Fair enough. So you seem like a fairly young guy, Ian. I don't think we'd be too far off in terms of vintage. And the reason I bring it up is a lot of the news, the financial news and real estate news has been, record this and record that. And from the 70s in terms of inflation and the 80s. The actual investment thesis that you guys put forth, and we'll put a link to it, it's called Higher for Longer. And one of the kind of points here is basically saying that we're in a contraction period right now, where we haven't seen interest rates rise like this in 22 years. So I guess for somebody that hasn't been physically around for some of these recessions that we've seen in the past in the commercial real estate world, how have you navigated and how have you gone about navigating over the last 2 years from probably since we last spoke? I think in the US, I know in Canada, there's been 10 interest rate increases. I think it's probably similar in the US. How's that period been sitting from your vantage point?
To be honest, it's been challenging. It's been very challenging in the sense that what we talk about in the investment thesis is that a lot of what we did, which was relevant at the time, and if you kind of like put it into a broader term, say what was the last decade or so, it was the era, what we would say, of free money. It was interest rates that had plunged down to levels where we had seen them go. I mean, we saw interest rates actually, and treasuries even go like, almost negative, right? We saw certain markets, we saw German bonds trade into negative interest rate territory range. So we had this market where when a material part of the capitalization of a deal, in most cases, the majority of the total capitalization of a deal, is when that capital is so cheap, it incentivized a host of different forms of a behavior, but one of them was chasing hard assets. So asset prices were chased up. They were facilitated obviously by, you could lever very cheaply. It was, we were having, experiencing decent rates of economic growth. We saw, obviously we saw occupancies for a lot of the asset classes remain strong, rent growth occur, and so forth. Household formation occur as that market progressed. And so we sat to that kind of pinnacle point where, when we reached in 2021, my recollection is that we got below 4% nationally on industrial cap rates. We got just below or at about 4% on multifamily cap rates. I mean, these were, that was kind of what we would say at the point where the market was more or less kind of priced to perfection. You were buying the potential for future growth. That's what you were buying in a real estate asset. So then we kind of fast forward to the beginning of 2022, and when that market changed, and when we saw, this precipitous, just huge interest rate increase increments, like we said. I mean, now we even have a 10-year treasury that's sitting at the highest point it's seen since 2007. But when you take the Fed funds rate and you move it for essentially 0 to, almost 5.5, and you do that in the course of a year, and you do that against a backdrop of, national cap rates of multifamily trending down towards 4, you suffer a lot of pain. And that's where the market's working through right now. And if we think about things that we're not doing today that we were doing before, is what I'd say is an example of right now in today's market, constructing ground up multifamily, it is extremely challenging from the sense of, you really did need, cheap, plentiful, debt capital in order to go out to put a construction loan on a deal. And for people who aren't super close to building multifamily assets or building assets in general, you do have to remember that construction debt is by definition typically variable rate debt, right? We don't get to put agency fixed financing on a ground up deal. And so there's a lot of assets right now that were financed in the 2020 period, 2021 period. They were financed with the variable rate debt. Variable rate debt typically will have rate caps on it. And so there was a reasonable amount of hedging that was done at that time. But what we also know about rate caps is that they expire. And if we go back and we say, what was the average duration of a rate cap that was put on a project with variable rate debt in 2020 or 2021, the average is between 2 and 3 years. And it's usually a little bit closer to 2 than it is 3. So fast forward to today. Well, now with rates going from, from that benchmark rate going from 0 to now upwards of 5.5, your rate cap has expired, which means that your debt that used to cost you, when you put that debt on the property, cost you 4.5%, could cost you 9% today. And you don't have to be, brilliant in math to understand that that's a lot of interest and money in a deal, on a loan. And it has absolutely wiped out cash flow for assets that are existing. And it has wiped out cash flow to the point where it has maybe potentially put the net operating income, or I should say the net cash flow of that asset into negative territory. You combine that with a debt market that is illiquid, so it's not trading. To the extent it's trading, it's very cautious. It's expensive, and they don't want to, they're not really putting out much in terms of proceeds. So you may have financed an asset in 2020, 70% loan to cost would be a good example of something that got done. Let's just say we're buying that asset. Now our variable rate debt has our cap has expired, our rate has reset. What was 4 to 5% now looks like 9% interest rate. It's wiped out the cash flow. You need to replenish it. That's happening, I would say, writ large across the industry right now. And the level of distress that is inserted into that asset has, I would say, pretty much a high correlation to what was the initial leverage put on that asset when it was built or acquired, and what was the overall business plan at that time, and how much betting on the future was required in that versus what was present at the time. And if there's two scenarios that look pretty depressing right now for deals, it would be highly levered development deals that are trying to stabilize but can't afford their current capital structure, or deals that were purchased within the last 2 years that were, I would say, highly value add in nature. They didn't have the requisite net operating income in place. The assumption was being that we were going to build a lot of NOI through enhancing the property, investing in it, increasing, investing capital into the interiors, into that project, turning that into, a more valuable asset that would go out and then achieve much higher rents. To the extent that that wasn't executed flawlessly, those projects are now what we would kind of say somewhat underwater. And so that's what the market, I think, is really grappling with, is this, massive level of stress that it's put into the market. And just like any market, it's cyclical. Real estate, being a cyclical market, will work its way through this current state. We're starting to see glimmers of hope and some signs that market clearing activity is approaching us. And in the meanwhile, it's a bit of a slog, and it's finding individual assets that seem to be appropriately priced, appropriately capitalized, appropriately situated into the current market in order to succeed. And I think that's kind of indicative of what the market looks like, today.
Yeah, it's, the first thing I'll say there, I got the sense a few years ago, even I was speaking with other brokers at my shop, and we were talking about the fact that there's almost like a relief that 3, 4, 5 years ago, we were all like, this can't go on forever. Like the other shoe has to drop here. And from prior to lockdowns, prior to everything that's happened over the last few years, there was really nothing that was saying what that was going to be. And then, the world happened and unfolded the way it did. Just on those 2 points, what I find fascinating about this, you talked about the challenges with development and value add. And I don't mean this disparagingly, but I don't personally consider development as real estate investing per se. There's a lot of speculation that's involved with that. So I see it as a completely different animal. But what I find fascinating is that both on the development front, and I think more so on the value add, a lot of these companies and investors, there was fundamentally nothing wrong with the way that they underwrote these assets in a lot of these cases. The LTV was good. There was a plan, there was a sensitivity analysis done with interest rates, but then you have, like you said, going from 3-4% to 8-9-10%. How have you seen these? Say, let's take the value add example. What have been the options basically on the table? Have they been on the majority of the investors you deal with? Have they been trying to negotiate extensions, punting the current debt they have, trying to kind of come up with other creative options to get them to a place where they think maybe stabilized debt at a more preferential rate is what they see in the future?
Yeah, good question, Jesse. And I would say that we're seeing predominantly there's a couple options in that scenario. And I would say we're seeing in most cases is the scenario where the operator of that asset is going to look to maintain, because when you get into a scenario where your current capital structure is not feasible, at its most basic level, you have two options. I either fix the current structure. If I can't fix the structure of the capital structure in this deal, and it's simply not tenable, then you're left with the option to sell it, right? Like there's kind of like, it really can become that binary at its core. But then so now you look at a real estate market like today, we would say we track Greenstreet as a decent proxy for what commercial real estate values are in the United States in the private market. If you look at Greenstreet values for multifamily, they're down about 22-23% from peak. So they're certainly resetting. And if an operator is sitting with an asset in a scenario where they did acquire it in let's say they put a 5-year note on it, had 3 years of initial IO, but had 2 years of extension, that 3-1-1. That was a very typical scenario for a value-added asset in that period. And if they get to now today in 2023, where that has expired, and again, we just talked about how it might have a cap. But to your point, if they're sitting with what they would say is, this is a good asset, it's in a good location, my occupancy is actually strong, it is in the mid-90s. There's nothing necessarily wrong with the asset at the street level, but my debt is now too expensive I've dropped below, we would say a 1.0 debt coverage ratio. What you're probably going to do and see in that scenario is the operator negotiate with the lender to basically say, what's it going to take to get to the extension? And in most cases, what we have observed is that the lender will say, what is required is, we need you to buy a new cap. We need you to buy down the rate. And we'll put you into the extension zone, provided that, despite the fact that SOFR is 5.25 to 5.5 today, we think you can strike SOFR at 3%. 3% would translate into an all-in rate once you apply the spread, that your asset now is back to what we would say a 1.25 debt coverage ratio. That's kind of how the lender is going to do that. Otherwise, they're going to say the other option is you could pay down my debt. And if you don't want to buy a cap, you're going to have to buy a cap anyways, basically. But if you don't want to buy a cap at current strike, the other option is you're going to have to reduce your debt coverage one way or another. And so your levers are either reduce your leverage or reduce your rate. And reducing leverage is super expensive right now, because that might entail putting in $10 to $20 million into a project, versus if you take a pretty typical, decent size value add deal from that period, and you say, hey, it's got a $40-50 million loan on it today, I need to buy down the cap on a $50 million loan. If you're buying down the rate today, that might cost you $2.5 million for 2 years, maybe $2 to $3 million, in that range. That's expensive. That's painful, but that's probably what you're doing. And then, and in that scenario, that's probably going to generate a capital call from the operator to the limited partners. They're probably going to assemble a bit more working capital behind the asset, explain to the investors that this is where we are. We're going to move into the extension range. We're not going to sell in the current market. Moving into the extension range of the loan is going to require us to strike SOFR at 3, lock that in for the next 2 years. If we do, we now, on today's occupancy and today's rent roll, we have a 1.25 cover. We don't think we go backwards from here, so we think we've got asset good, structure good. This is what it's going to cost to get there. That's probably your scenario, because otherwise you're either looking to refinance, but refinance is going to be lower LTV, so they're going to have to come up with a lot of money. Given the constraints and what the pricing of what debt looks like, the idea of going out and acquiring mezzanine financing or preferred equity in a multifamily asset, it's not really feasible today. Again, this combination of low former, cap rates that got really low in multifamily, they were the most sensitive to the expansion in interest rates. And so that's what's really causing a lot of distress across that sector specifically. And I want to say that sector specifically because if you look at other asset classes, they're not quite in the same boat. The story gets better if you start to look at industrial. Industrial is experiencing rent growth that is stronger than multifamily. Multifamily rents are flat to down nationally, right? Year over year. They're down 7-8% in some of the hottest markets. If you look at Phoenix and Miami and so forth, so industrial isn't in a different, it's in its own kind of cyclical market right now. We are still seeing rent growth is still occurring. It's single digit. It's not double digit anymore, but it could still be 6, 7, 8% on an annualized basis. We're still seeing occupancies remain strong, still solidly mid-90s in most markets. Industrial is just still more, fundamentally in demand relative to the supply that was there. So it's a little bit still relatively undersupplied. Lending is still a little bit more, there's no market that's, asset class that's easy to lend on right now, but industrial is definitely easier. And we're still seeing even instances where ground up development in industrial can pencil, so we can still look at that. And then if you look at across other asset classes, hospitality and retail, hospitality coming out of its own, it got absolutely slaughtered during the pandemic. So it already experienced such a precipitous drop in its volatility. And now that with travel resuming in the United States, occupancies are strong in the hospitality sector. A lot of the fundamentals are really there. Occupancy is not quite to like fully pre-pandemic level, but what is better is rate. So when we combine those two, that's when we get to RevPAR, revenue per available room, I should say. And RevPAR is now back up to record levels. So it is that sector is recovering. It is a higher cap rate sector by and large. So it's while there's no doubt that the financing or lack thereof right now is affecting the hospitality sector, and it's certainly creating a drag on pricing. Pricing in that sector is more down single digit. And there's just a lot more fundamentals in place there. And retail similar, right? Got destroyed during the pandemic in the United States. It came out, it bounced back. It's had no new supply. And actually we're back into a world where people are wanting to go back out to retail centers, spend time, and actually get to a sticks and bricks shopping experience. And so that asset class also, I think, sits in a relatively good place. But it's also fair to say that the financing market is affecting everything to a degree. It just depends on to what degree is different by asset class.
Yeah, I think we're seeing this across the board too. The term of cash in refinance as opposed to cash out capital calls from LP investors. I think that's, I think I feel that we're in a price discovery environment right now where, office is a good example of this. Of if you have a good performing office, or relatively good performing office, if you've looked at the actual value of it today, you might take a 20-30% hit. So if you're in a position where you have to sell, that can be extremely frustrating. I'm curious, I've seen, at least in the Canadian context, I've seen apartments transaction volume down 65%. I've seen JLL's report in the States of as much as 75% down in terms of transactions. How do you see this over the next few months? It feels as though, or probably the next few years, as maturity dates come up, that this price discovery is inevitable, that it's going to happen. But right now I feel like we're still kind of in this transitional period where, and people maybe have taken product off the market, but they're not at a point yet where they have to actually sell the asset.
Absolutely. I would say that is exactly what we're seeing in terms of transaction volume. It's very slow. If we look at RCA data, just to give it some context, 2023 has been kind of clicking along at an average of about $90 billion per quarter. So assuming that Q4 would actually remain on track, okay, that gets you to 360 billion annualized. You saw 2021 annualized at like what, 870 to 890 billion or 8 or 90 billion. So I mean, down more, we're down less, over 50%. Apartments alone are down 65% year over year. And what's also important to note, I think, is that if we look back to 2022, we actually saw Q4 being the lightest quarter for transaction volume of that year. Has to do some with the timing, right? We were sliding into, this real estate recession. We were experiencing these upticks in interest rates, and it just kind of was getting more and more bleak as we were getting to the end of the year. So that's I would say the primary driver of why 2022 Q4 was relatively bad compared to every other quarter that year. The other factor that I do see affecting last year that I think could affect this year is that Q4 is historically a period of the year where there is a rush to get those final deals done in the year. And everyone kind of wants to kind of put some points on the board, get to the next year, and then reset. Now, 2022 just didn't have any reason to try to rush. Why would you rush to do a deal in Q4 of last year? And unfortunately, I think we're in that same situation right now. Why would you rush to do a deal in Q4 of 2023 when you think and hope that there might be a slightly better market ahead of you in the early to middle part of 2024? So while we've even been clicking along at 90 billion per quarter this year, if I had to bet, I would take the under on 90 for Q4 relative to the over, just from that standpoint. I don't like, if we look at last year, I think it dropped about a third into that quarter, by just so 33% drop from kind of the average into Q4. I don't think we dropped that much, but I'm kind of getting ready to see that be down to like 60 to 70 billion, call it 70 billion, maybe down from 90. And if we look at what 70 billion looks like relative to peak, well, peak volume was about 370 billion in Q1. So now we're down like over 80%. And so this is where I would say the market, from just a velocity standpoint, is really starting to feel like parts of the GFC. I mean, we saw 2009 just drop. I mean, it just fell off a cliff. And it's quiet enough now that it's starting to feel similar from that standpoint, which also, I mean, if we flip that around and say, is there a silver lining there? I'd say that to the extent that the silver lining is, say, like, we really might be getting towards a trough, because the bid-ask spread is high enough at a time where there's just nothing going on relatively, that tends to break over, a period of months, not years at that point. And that's what gives me some optimism that if we look at next year, we start, and if we think we're at peak rates, my personal opinion is I think that the Fed will no longer raise rates. Then the question becomes, when does the Fed, and if we assuming that is reality, but let's just assume for a second we are at peak rates, then the question becomes, when does the Fed begin to lower rates? My personal opinion on that is, I think, around September, but I would hope I'm wrong to the further side than the shorter side. But it does suggest that if we have a little bit further attrition in pricing, a little bit more of, kicking the can's going to have to stop a little bit in some of these deals. Some stuff's going to get flushed out. We start to see a little bit more market clearing activity. That's where I get more confident in the concept that, market reset pricing really may hit solidly in Q1 of next year. And then we might actually start to see some improvement on the prospect of, hey, maybe the interest rate environment is going to ease a little bit. Maybe that's going to create a little bit more liquidity in the capital markets. What we do know also is we know that there's a lot of dry powder on the sidelines, but it's looking for the green light, right? The light's still pretty red. And so I think if the red light starts to just, kind of dim a little bit, and maybe we get that little bit of a hint of green, that's when I think you could start to see some money flow in. And maybe then at that point, if we pair that with a little bit more liquidity in the debt markets, we might be off to the beginning of the next cycle.
So I want to be mindful of the time here. I feel like we should do another half an hour, 45 minutes in 6 months from now, because there's probably going to be a lot to talk about. But I want to end on an optimistic note here in terms of where you are seeing the potential opportunities over the next couple of years. And, on this point of coming into next year, one of the things that it's been fascinating to me is that a lot of the people that I follow, way smarter than me in the financial industry and the real estate industry, talk about, you look at history and that this type of inflationary environment usually ends with some sort of recession. But the backdrop from the US and Canadian market is that, some people say that is imminent. And then you hear, like I said, a lot of very smart people saying consumer spending is up. Like you said, they're back in hotels. The economy doesn't look like there's cracks fundamentally. So it's really, you're getting both sides of the equation. So I guess in answering the question where you think opportunities are, maybe you could also talk a little bit about what you see the 2024, 2025 general economy looking like from the data that your team looks at.
Yeah, absolutely. So while I openly admit that I'm not an economist, I'll say that I study a lot of people that I think are intelligent economists, or groups that I think that are intelligent as they approach the economy. And let's just, so for example, based upon what I read and what I think, if I were to again, going with the over under, do we or do we not go into recession next year? I'm still in the not going into recession camp. I look at, for example, if we pay attention to things like the job numbers continue to be resiliently good. We would need to see a material change in the jobs numbers and some weakening in that, and potentially, because we need to see ultimately a spike in unemployment. That's going to give you that changes behavior enough. Like right now, the job market's still, I'd say, too strong for us to really believe that we're going to get any sort of a real recession out of it. I mean, could it be very, very low rate of growth next year? Of course. I think, sub 1% GDP growth, that's certainly, I think, on the table. I just don't see negative GDP growth next year right now. The other thing I'd say I pay attention to is you track a lot of the banks, for example. Goldman Sachs is very good at coming out with their repeated, level of what they assess as the probability of recession in the next 12 to 18 months. Their probability continues to go down. They had it in the 30s, they went into the 20s. I think they're now maybe at 15% now. I forget their last downtick. I don't have it in front of me. But point being is that Goldman Sachs kind of continues to update their forecast. And as they do, they actually decrease the probability in their minds of going into recession. And so I think from the next 2-year perspective, I think that when we think about this from a marketing position perspective, I do think that 2024 is the year where you look to position yourself into acquiring assets that you think have been appropriately discounted to a level that, for lack of a better term, look a little bit like a bargain relative to peak pricing, and you maintain some patience. And from a real estate operating perspective, when we acquire that asset, or if we start to build that asset, we make sure that we have allocated sufficient resources to it to see it through a continued period of slow growth, whether that's another 1 to 2 years. But ultimately, I think that 2025 is the year where you do bet on growth. You think at that point, logical minds would say that we are starting to be into a decreasing interest rate environment. History would suggest that from a hard asset perspective, anytime that you can acquire hard assets in an interest rate environment of which the future interest rate environment is lower, that generally leads to asset appreciation. Not always, not in every circumstance, but writ large, you like that environment. Hey, I'm going to go acquire assets in a SOFR plus, in a 500, 550 SOFR, market, and maybe sell them in a 350 SOFR market. Like that's a good, right? I mean, that's a good type of, Fed funds rate kind of market. That's overall a generally good investment thesis. The opposite is generally not a good investment thesis. So you have to believe ultimately in a lower interest rate in 2025 for you to get kind of bullish. If you do believe in a lower interest rate in 2025, and then maybe a gradually decreasing interest rate in 26, then that would suggest that 24 is the year to go out and find those deals. Like I said, I don't think they're going to be, you might have to be a little bit patient in seeing the acceleration of that growth, but to the extent that assets start to reprice, and we are just beginning to see some asset repricing that is looking more like 30 to 40% off peak, that's where that gets interesting. That's where I think you're getting to rock bottom pricing. And I don't think, for example, if we do get to asset pricing that is 30 to 40% off peak, I don't think we see a further leg down in all asset classes, other than, I would say, office is the caveat. We haven't really gone into office. It's in its own cyclical bear market. But even in the office sector, I think that next year is probably the year where you could see some things that trade at such rock bottom levels that you're saying, I can buy this asset unlevered. I can be very, very patient for it. And I think that ultimately by 27 or 28, we have a better market for what this particular office asset is. That's the other part where it could be very interesting to see some very opportunistic entry points in that sector, while we might truly get to the bottom of most every other sector with the prospect of some growth in those out years.
That makes sense. Ian, for those interested in following up with Crowdstreet and what you guys are doing, what would be the best place to send them? We can put a couple links in the show notes.
Sure. There's two things. One, you can go to the website crowdstreet.com. There's a lot of ways to look at educational information. There's ways to reach out to people at the website. That's a good starting point. And if anybody in particular individually would like to connect with me, I'm on LinkedIn. I'm the only Ian Formigli on the LinkedIn platform, so I'm very easy to find. You type in my name, you can hit me up. I'm happy to connect. I love talking with investors about real estate.
My guest today has been Ian Formigli. Ian, thanks for being part of Working Capital.
That's a pleasure, Jesse. Thanks.